When you look at American Airlines Group, ticker symbol AAL, are you seeing a falling trend flashing massive sell signals? Or is this actually a strong buy that the market is severely undervaluing?
That is the million-dollar question today, isn't it?
It really is. Welcome to today's deep dive. We are taking a massive stack of real-time market data, technical charts, analyst reports, and honestly, some absolutely breaking news from today, April 13th, 2026.
Yeah, and the goal here is to figure out if AALs is a hidden gem or if it's just a classic value trap.
Exactly. But before we get into the numbers, I have to pause for a second. You must like the video, subscribe to our YouTube channel, and it is absolutely compulsory to leave us your comments and feedback down below. I mean, we need to know what you think about this stock.
Definitely do that. And just to set the ground rules before we get into it, this deep dive is a natural human debate exploring the data.
Right, strictly for educational purposes.
Yes, absolutely no financial advice is being given here. You are in control of your own portfolio.
Okay, let's unpack this. Because the price action we just saw today on Monday, April 13, was pure whiplash.
Whiplash is the perfect word for it.
I mean, during regular trading hours, AAL closed down 0.80% at $11.23. It was just a sleepy, slightly red day.
And nothing to write home about.
Right. But then the closing bell rings, and the stock absolutely explodes in after-hours trading. I'm talking surging over 5% to reach $11.81.
Which is huge for a legacy airline.
It is. You don't get a 5% after-hours jump on a major airline without a massive catalyst. And here is the breaking news that caused it. United Airlines CEO Scott Kirby has reportedly been discussing a potential merger with AAL.
Wow. What's fascinating here is the immediate psychological reaction of the market. When a merger rumor drops like that, it creates instant speculative order flood.
Because people want to get in early.
Exactly.
Yep.
You aren't seeing long-term investors slowly accumulating shares. You're seeing algorithmic trading systems and retail traders just flooding the options chain. The order sentiment right now is this vicious tug of war.
Wait, explain that tug of war a bit. Because to a lot of people, a 5% jump just looks like everyone is buying and everyone is happy.
Yeah, it looks like pure optimism on the surface. But underneath, it's highly fractured. On one side, you have speculative buyers aggressively chasing the rumor.
The people buying the short-term call options.
Right, they are buying calls, trying to catch the momentum of that 5% pop, betting the stock will just keep rocketing upward tomorrow.
Okay, so who is on the other side?
On the exact opposite side, you have cautious, experienced traders rapidly buying put options. They are hedging their bets.
Because airline rumors are notoriously flimsy.
Totally. They know merger rumors are historically very fragile in this industry. A put option acts like an insurance policy.
So if the rumor gets shot down tomorrow morning.
Exactly. If either company's PR department issues a denial before the opening bell, that 5% after-hours gain evaporates instantly. The stock could completely crater. So the people buying puts are betting on that collapse.
So a merger rumor is basically a great sugar high for a stock. It gets the blood pumping.
That's a great way to put it.
But if United is actually kicking this tires, they have to look past the rumor, right? They have to look at the actual balance sheet.
And that balance sheet is a wild ride.
It really is. I was looking at their top-line revenue, and it looks like everyone in the world is flying American right now.
The revenue numbers are staggering.
Yeah. But the actual profit left over at the end of the year is practically zero. How bad is the gap here?
It's almost hard to comprehend.
Yeah.
Let's look at their full year 2025 annual income statement. American reported a record-breaking $54.63 billion in total revenue.
$54 billion. That's with a B.
With a B. And $14 billion of that was generated just in the fourth quarter alone. They are moving an unbelievable amount of money through the system.
Okay, so what's the catch?
The reality check is that out of that $54.63 billion, their GAAP net income,
The actual profit they get to keep.
right, their net income was a measly $111 million for the entire year.
Oh, wow. That is nothing compared to $54 billion.
It's incredibly small. It breaks down to a diluted earnings per share of just $0.17.
17 cents per share. Let me put that into perspective for you. It's like a wildly popular restaurant with a line out the door, right?
Right.
But the kitchen is burning through money so fast they can barely afford to keep the lights on. Like whether you have 10 passengers or 10,000 passengers on a cruise ship, you still have to pay for the fuel, the captain, the maintenance.
And the massive loan on the boat itself.
Yes. Your expenses are largely locked in before anyone even boards. So the difference between making a massive profit and losing your shirt comes down to just selling those last few tickets.
That is the perfect analogy. It is the ultimate volume versus margin problem. Airlines operate with incredibly high fixed costs.
Planes are not cheap.
No, planes, union labor contracts, terminal leases, they don't get cheaper just because a flight is half empty.
Hmm.
So their profit margins are razor thin even in a perfect environment.
And we definitely are not in a perfect environment.
Not at all. When an external shock hits, it cuts directly into that tiny sliver of profit.
And airlines are more vulnerable to external shocks than almost any other industry, wouldn't you say?
Oh, without a doubt. Just look at late 2025. There was a government shutdown.
Right, I remember that.
That single event wiped $325 million in revenue right off Americans' board.
Just from the shutdown.
Yeah, simply because government travel halted and overall consumer confidence dipped. And then, just as they were trying to recover from that, we rolled into the first quarter of 2026 and hit Winter Storm Fern.
Oh man, Fern was brutal.
It was. That single weather system caused over 9,000 flight cancellations for the airline.
Wait, 9,000 flights?
Over 9,000. And when a plane doesn't fly, you still pay for the lease on the plane. You often still pay the crew, depending on their contracts.
Plus the nightmare of moving empty planes around to get them back on schedule.
Exactly, the logistical nightmare of repositioning. But you still have to refund the passengers.
Oh.
That one weather event equated to an estimated $150 to $200 million in lost revenue.
So that $111 million net income from last year.
It shows just how quickly a few bad weeks of weather or some political gridlock can completely erase an entire year's profit margin.
Which brings us to the undeniable elephant in the room, the debt.
Yeah, we have to talk about the debt.
You cannot look at AAL without looking at the liabilities. Total debt sits at a staggering $36.5 billion at the end of the year.
That's a massive number.
Net debt is at $30.7 billion. That is an absolute anchor tied around their ankle while the water is rising. How do they even survive that?
It sounds apocalyptic, I completely agree. But this is where we have to look at the other side of the balance sheet. Because survival in the airline industry isn't just about how much debt you hold.
What is it about then?
It's about how much liquidity you have to service that debt. Liquidity is what keeps an airline out of bankruptcy court when those external shocks happen.
Okay, so how much cash do they actually have on hand?
AAL ended the year with $9.2 billion in available liquidity.
Wow, okay. So they have a massive rainy day fund.
Precisely. That $9.2 billion is a massive cash cushion designed specifically to absorb things like Winter Storm Fern.
Okay, that changes the picture a bit.
And furthermore, despite the razor-thin margins we just talked about, the sheer global scale of their operation allowed them to generate roughly $1.0 billion in estimated free cash flow over the year.
$1 billion in free cash flow.
Yeah. So they are heavily leveraged, yes, but they are also generating enough actual cash to service that mountain of debt without having to drain their emergency reserves.
Okay, so if they have this massive debt load and the weather is constantly eating their margins, you'd think Wall Street would be sprinting for the exits.
You would think so.
But the technical charts and the analysts are telling a completely different story.
Let's look at the technicals.
So the 52-week range is a high of $16.50 down to a low of $8.96. The long-term trend is undeniably bearish, right? The stock has been trading well below its 200-day simple moving average.
Right, which is a key indicator.
Now, for anyone listening who isn't staring at technical charts all day, why is falling below that 200-day average usually considered a major warning sign?
Well, the 200-day simple moving average takes the closing price of the stock over the last 200 days and averages them out.
It smooths out the daily noise.
Exactly. It gives you the macro sentiment of the market. When a stock is trading consistently below that line, it tells you that institutional investors are broadly pessimistic.
So the heavy hitters are staying away.
Right. Traders generally consider it a break in chart until it can cross back above that line.
But then the short-term chart is doing something weird right now. I keep seeing technical analysts pointing at this recent price action and talking about a falling wedge breakout.
The falling wedge.
Hold on, a falling wedge sounds like the stock is just collapsing further. Why is that considered a coiled spring for a breakout?
It definitely sounds counterintuitive, but a falling wedge is actually a classic bullish reversal pattern.
How does that work?
Imagine the price is bouncing between an upper resistance line and a lower support line, and both lines are pointing downward. But the lower line isn't falling as fast as the upper line.
So the trading range gets tighter and tighter.
Exactly, forming a wedge. What this tells us psychologically is that the selling pressure is exhausting itself. The bears are basically running out of shares to dump.
Oh, I see.
And with that after-hours spike up to $11.81, fueled by the merger rumor today, we are seeing the price physically break out above the top of that wedge.
And the momentum indicators are backing that up, like the RSI and MACD?
Yes, absolutely. If we connect this to the bigger picture, the MACD is shifting aggressively.
Remind me what the MACD actually measures.
It measures whether the stock's short-term momentum is accelerating faster than its long-term trend. Right now, it's telling us the bleeding has stopped, and momentum is shifting from oversold to neutral and starting to lean bullish.
Okay, let's map out this battlefield for the listener. If you are watching the stock tomorrow morning, you need to know where the walls are, where is the support.
On the downside, your absolute floor is that 52-week low of $8.96.
That's the do or die line.
Yeah, along with a recent consolidation zone, right around $10.80. If it breaks below those levels, all bets are off.
Then on the upside.
Your immediate resistance is today's high of $12.48.
Right.
If it can break through that, the next massive overhead resistance is way up at $15.37.
But there's a key line in the middle, right?
Yes. The line in the sand for a short-term trend reversal is holding the $12 line. If this merger momentum can push it past $12 and it actually holds as new support, the chart fundamentally changes.
And if it crosses that $12 line, Wall Street analysts are going to take a massive victory lap.
Oh, they definitely will.
Because I am looking at the consensus Wall Street ratings right now, and it honestly blew my mind. 57% rate AAL as a buy.
Over half?
Yeah. 39% say hold, and only 4% have a sell rating.
That is wild.
The average price target is $14.86 with a high target of $22. Wait a second, we just established they have $36 billion in debt. We just established weather wrecked their quarter. Are these 57% of analysts looking at the same company we are, or are they just blinded by the merger rumors? There has to be a disconnect in how they are valuing the company.
You've hit the nail on the head. This is exactly why retail traders often get so confused. It comes down to a valuation paradox.
Break that down for me.
It hinges on looking at the price-to-sales ratio versus the price-to-earnings ratio. If you look at the price-to-sales ratio, or PS, AAL is sitting at an insanely low 0.13x.
Meaning what, exactly?
That means you are paying just 13 cents for every dollar of revenue the company generates. Compared to the broader industry average, that makes the stock look radically, almost criminally undervalued.
Right. You see a company generating $54 billion in revenue, you see the stock trading for $11 a share, and you think, wow, I found a gold mine.
But that completely exposes the trap. You cannot just look at sales. You have to look at earnings.
Because sales don't equal profit.
Exactly. If we flip the coin and look at the trailing price-to-earnings ratio, the PE ratio, it sits at roughly 67x.
67?
Yes. Because those actual earnings, that tiny $111 million net income we talked about, are so incredibly low, the stock is actually quite overvalued on a trailing profit basis.
A PE of 67 for a mature, debt-heavy airline is astronomical.
It really is. We call it the retail trap. Novice traders log into their brokerage app, see a low share price of $11, see a tiny PS ratio, and think it's a massive bargain.
They completely ignore the downside risks.
Totally. They ignore the $36 billion debt load and the margin squeezes that are keeping that PE ratio inflated. They're buying sales, but they aren't buying profits.
Wow. But what if they are figuring out how to close that back door? What if the profits are coming not from flying planes, but from fundamentally changing the business model?
Now you're looking at the long game.
Because looking at the insider moves, there was a major curveball in March 2026. Just last month, Mary Dillon was elected to the American Airlines Board of Directors.
This is such a crucial detail.
Right. For anyone listening who might not follow the cosmetics industry, Mary Dillon is the former CEO of Ulta Beauty. At first glance, putting a retail cosmetics executive on the board of a massive legacy airline makes zero sense.
On the surface, yeah, it seems completely disconnected.
Yeah.
But strategically, this is a massive signal.
What is the signal?
Think about what Mary Dillon did at Ulta. She built one of the most powerful, high-margin retail loyalty programs in the entire world. And here's the dirty little secret of the modern aviation industry.
I love dirty little secrets. Lay it on me.
Airlines barely make money flying you from New York to Los Angeles.
Wait, seriously?
Seriously. They make their billions selling frequent flyer miles to credit card companies. They're essentially tech loyalty companies with a side hustle in aviation.
Hold on, let me stop you there because I think a lot of people don't realize this. The airline sells the miles to a bank.
Yes. Airlines sell their frequent flyer miles in bulk to banks like Citi or Chase. The bank pays the airline billions of dollars in cash up front for those miles. And then the bank uses those miles to reward you, the consumer, for using their credit card. Selling miles has incredibly high profit margins because a mile is essentially a digital currency the airline creates out of thin air.
That is genius.
So by bringing Mary Dillon onto the board, AAL is signaling a hard pivot. They know they can't control winter storms or government shutdowns, so they are trying to fix their margin problem from the inside.
By maximizing the monetization of their loyalty program.
Exactly. They want to tune the airline into a high-margin retail ecosystem.
That completely changes how you look at the stock. So if the board is making these brilliant long-term strategic moves to turn the airline into a high-margin bank, basically, but the short-term reality is a volatile mess of winter storms and debt, how do we weigh the outcomes from here?
It's a tough balance.
What is the bear case versus the bull case?
Let's start with the bear case, which is essentially a worst-case continuation lower.
The dark timeline.
The dark timeline. The biggest glaring issue is operational fragility. If a single event like Winter Storm Fern can derail an entire quarter and cost up to $200 million, the foundation is inherently shaky.
And weather events aren't going away.
Right. The bears argue that climate volatility is only increasing, meaning these disruptions will become more common, making earnings entirely unpredictable.
Plus regulatory stuff, right?
Yes. Add in the ongoing regulatory pressures from the FAA, plus inevitable labor cost increases as unions negotiate new contracts. And those incredibly thin margins could easily go negative.
And if earnings stay negative,
That $36 billion debt gets heavier, the liquidity cushion drains, and the stock is highly likely to be dragged back down to test that $8.96 support level, or even break below it.
okay, that is definitely a scary scenario. But I will eagerly counter with the bull case, the best case recovery scenario.
Let's hear it.
Because early 2026 isn't just about storms. There is actual tangible growth happening. The company is showing double-digit revenue intake growth in the early months of the year.
True, demand is still there.
And there is incredibly strong demand for premium cabins. Those high-margin seats at the front of the plane are selling out. And while $36 billion in debt is absolutely terrifying, we have to give management some credit here.
They've been aggressive with it.
Exactly. They aggressively paid down $2.1 billion in debt in 2025 alone. They are actively deleveraging the company.
And this brings us to the outlook, where we have to explicitly separate the short-term noise from the long-term plan.
Because they look very different.
Very. In the short term, meaning the next few weeks extreme,
Yeah.
high volatility is absolutely guaranteed. We are leading right into the April 23 earnings call.
And the guidance isn't pretty?
No, management's initial guidance has already warned investors to expect an adjusted Q1 loss between $10.50 per share, purely due to the winter storms.
So the next few weeks are going to be a bumpy ride as the market digests those official losses.
Especially against the backdrop of these new United merger rumors.
But if you can stomach the short-term volatility and look past Q1, stretching into the end of 2026, what's the grand plan?
The grand plan for management is twofold. First, they are officially targeting to get total debt under $35 billion by the end of 2026.
Okay, making a dent.
Second, they're projecting free cash flow to surpass $2 billion for the full year. If they hit those targets, the financial health of the company transforms.
And they have major catalysts lined up to help them get there, right?
Absolutely. 2026 is their centennial year, 100 years of operation, which brings a massive global marketing push.
Well,
But more importantly, tying back to Mary Dillon, they are executing a highly anticipated transition of their loyalty credit card partnership over to Citi.
the credit card pivot.
Right. If the board can leverage that Citi partnership to significantly boost loyalty revenue, that $2 billion free cash flow target becomes very realistic.
So bringing this all together, American Airlines is the ultimate battleground stock right now.
It really is.
On one side, you are trapped. You are looking at $36 billion in debt, operational nightmares where a single snowstorm wipes out a quarter of profit, and an inflated PE ratio that screams retail value trap.
That's the bare reality.
But on the other side, you have record-breaking $54 billion revenues, aggressive debt paydowns, strategic boardroom upgrades with loyalty program experts who want to turn the airline into a digital bank, and now explosive after-hours merger rumors with United Airlines that could change everything.
And that merger rumor is where we find the true unknown.
How so?
Because if United and American Airlines actually did attempt to merge, it wouldn't just change AAL's stock price overnight. It would fundamentally rewrite the antitrust rulebook.
It would be a massive monopoly.
It would permanently alter the competitive landscape of global aviation. The question you have to ask yourself before you get swept up in the after-hours buying frenzy is, given the current legal environment, would antitrust regulators ever let a monopoly of that immense size off the ground?
A phenomenal point to end on, because regulators have not been friendly to mergers lately.
Not at all.
So what does this all mean for you? You have the bull case, you have the bear case, you understand the retail trap, and you have the technical battle lines drawn. Now it is time to do your own research.
Dive into those April 23 earnings when they drop.
Exactly. Investigate the options chain, look at the debt, and remember, this is a debate, not financial advice.
Stay smart out there.
And please, like the videos, subscribe to the channel, and hit the comments with your take. Is AAL a value buy or a trap? Thank you for taking this deep dive with us, and we will see you next time.